All right, welcome everyone. We're talking about preparing for the estate tax sunset. The estate exemption is going to be cut in half on December 31st, 2025. So what can you do now to prepare? That's what we're going to be talking about today in this live webinar. And maybe what should you do now, right? So I'm going to give you 6 strategies that you may want to implement. And real quick, my background, I'm San Diego and Salt Lake City trust and estate attorney Kristina Hess. I grew up in San Diego. I'm the mother of 3 boys. I'm married. I have 3 bonus children. We have a splendid blended family. And I went to UC Berkeley School of Law, been an attorney for over 25 years this fall. And I opened my own practice in 2009. I'm a certified specialist in estate planning, trust, and probate law. And we have offices in San Diego and Salt Lake City. We have 2 attorneys in San Diego, and hopefully we'll be adding another one next year. All right, so let's talk about your legacy, because when we talk about death and taxes, we talk about the legacy that you leave behind. So I got into estate planning after my own father passed away suddenly. He really believed that a good man leaves an inheritance to his children's children. And he started that with my 3 boys and with my siblings' children, but he just died suddenly on a fishing boat in Alaska before he got to finish what he started. And that's really where I got my passion for planning. So as we're talking about your estate, and if you're watching this webinar and you have assets over, if you're single, over $7 million, or if you're married, over $14 million, then the rest of us have an opportunity as well, but there's an opportunity to leave a legacy, not only to your children, but also to a broader array of potentially charitable organizations or other causes that you may believe in. So what do you want to leave behind? So we're talking about death and taxes. They say the 2 certainties in life are that we're going to die and that there's going to be taxes. And it could be, is this a case of what must go up must come down? The estate tax exemption has risen, meaning the exemption amount is the amount that you can pass tax-free when you die, and that has gone up. And it is about to go down. It's about to go down to what it was pre-2018. And so is this a case of what goes up must come down? My dad, when I was a little girl, we'd ride roller coasters, and as we would be going up, he'd look at me and he'd say, "What goes up must come down." So is it possible, everyone, if you polled attorneys, CPAs, estate planning, tax attorneys, wealth advisors, no one knows for sure, but everyone seems to think that they're going to let the sunset happen. So what is this sunset? What are we talking about? The estate tax is a transfer tax that your loved ones pay when you die. So historically, it started, I believe, around 1916, the estate tax. The rates were as high as 70%. But if you look since the year 2000, you could pass $675,000 when you died. When I graduated from law school in 1999, I believe it was just over $600,000. So then we had the Bush era tax cuts. It gradually went up. And then we had, if you look at the 3rd column, the marginal tax rate. So the rates have ranged between 55% to the low of 35%, or of course, the perfect year to die, which if you're here, we all missed it. Fortunately, 2010, there was no estate tax, right? So George Steinbrenner, the owner of the Yankees, died in 2010 with $1 billion estate. IRS 0 on that scorecard. Steinbrenner heirs $1 billion. So where are we now? Right now, so in 2012, the American Taxpayer Relief Act, signed by President Obama and Congress, made the $5 million estate tax exemption permanent. So they said, okay, you know what? It's going to be $5 million, and that's permanent until they change the law. Nothing is really ever permanent, but at that time it was permanent. And then fast forward to 2017, 2018, Congress and President Trump, they doubled it. They doubled it to $10 million. And each of those numbers, the 5 million or the 10 million, is indexed for inflation. So in 2024, every individual has $13.61 million that you can pass tax-free. Every dollar over that will be taxed at a marginal tax rate of 40%. When it sunsets, the rate may be up to 45%. So what that means is if you died this year and you were single and you had $15 million estate, every dollar over 13.61, if 61 would be taxed at 40%. So what's going to happen on December 31st, 2025? It's going to go back down to the $5 million level. This $10 million exemption has a sunset because it expires. It expires on 12/31/25. It's going to go back down. Now, if you're married, each of you get an exemption. So this year, if you're married, it's over $27 million for a married couple that you can leverage to pass tax-free. Now, when I say leverage, what am I talking about? Well, what I'm talking about are the various credits. So there's the estate tax credit, which is the exemption amount we've been talking about. So this is the amount that the government says, okay, you have this amount to transfer tax-free when you die, as long as you're a citizen or you're a domiciliary of the United States. There's also a lifetime gift credit. And in 2013, for the first time, each of these exemptions that you see on the screen here were unified. So the lifetime gift exemption was unified at 10 million. The estate tax exemption was 10 million, and the generation skipping exemption was unified at 10 million. So for the first time, these were all across the board the same. Historically, the one that was low was the GST, the generation skipping exemption. That's the amount that you can pass to a skip generation. Historically, it's hovered around $1 million. Now, I don't know how many of you remember 2021, the Build Back Better Act. They wanted to make the estate exemption $3.5 million, the generation skipping exemption $1 million, and they wanted to eliminate the step up in cost basis on death. So who knows what can happen in the future? That's why we have a window of opportunity. You have a window of opportunity between we're in June of 2024 to December 31st. You have a year and a half. You have a window of opportunity to potentially leverage some of these exemptions before you lose them. So it's one of those use it or lose it kind of things. But let's say you give away $13.61 million now. When you die and you used your full lifetime gift exemption, when you die, if the exemption is 6 million when you die, you're going to have zero. If the exemption was 20 million, you would have 20 million minus 13.61. So whatever you use of your lifetime gift exemption will offset against your estate exemption. So you don't get both. It's one or the other. So that's why a lot of people are going down the blue column and they're using their lifetime gift exemption now, because although we don't know for sure, no one really thinks that the exemptions are actually going to go up, or the sunset's not going to happen. So there's no clawback. Also, that was Congress did pass that if you use your lifetime exemption now and go down later, they can't come back and try to get taxed. So this is a window of opportunity. That's why we're educating people about this. But here's the caveat. This is not one size fits all planning. This is something that is very custom tailored to every individual and family situation. So you need your team. You need your team. You need your family office team. You need your estate planning attorney. You need your CPA, and you need your wealth advisor. Every single person on that team should be involved in this analysis. And we all work together. I work very closely with the CPAs and wealth advisors of my clients because we want to make sure that we're looking at every angle. All right, so there's two tax codes, right? There's one of the Supreme Court justices historically said there's a tax code for the informed and then there's a tax code for the uninformed. So those of you who are planners and plan and are taking advantage of the tax law, and there's so much that you can do legally, morally, and ethically to disinherit the IRS, that's the informed tax code. So which one are you going to choose? It could very well be that having your heirs or your loved ones or your children or whomever pay taxes is optional. So that's where good planning comes into place. So let's dive into, before we do that, excuse me, we got to talk about the whack-a-mole game. So there's trade-offs, right? So I did allude to the fact that there's multiple taxes. We're talking about the federal estate tax transfer tax, the federal estate tax that is due when someone dies if your assets are over the exemption. Now, There's also, California does not have a state inheritance tax. Uh, Only 13 states do. So if you have a larger state, you wouldn't move to one of those states like New York, New Jersey, Washington. There's a few states that do. Saving estate tax may very well have income tax and capital gains tax consequences. So this is where the whack-a-mole comes in, because maybe you hit down the estate tax and you say, okay, I'm going to gift away my assets now. I'm going to use my lifetime credit. The kids or my loved ones aren't going to pay any tax when I die. But guess what? When you gift assets, you're gifting them with a carryover cost basis. So if you, let's just use a simple example. You bought an apartment building, a fourplex for $1 million. Now it's worth $10 million. So you decide to gift that $10 million fourplex to your children in a legacy trust. But what's going to be the basis? It's going to be $1 million, less any depreciation, plus any, improvements, that whole analysis. But your basis in the property is going to carry over to them. So when you die and it's worth 10 million, if it was in your revocable trust, if it was in your taxable estate, it's going to get a step up in cost basis on death. So they would get that dollar asset and pay no capital gains tax, unless, of course, Congress changes the laws. So you can see here that this is a significant trade-off that must be analyzed as you're thinking about this planning. And if you live in California, the difference between the capital gains tax rate, once you add in the federal rate, the state rate, the Medicare surtax, it's like 37.1 or, almost 38%. And then if you compare that to the estate tax at 40%, so you really need to be strategic. And so that's why we have to look at property taxes. If you have real estate in California, we have very unique property tax laws. So real property must be analyzed closely, because Prop 13's been around for almost 30 years. And what Prop 13 does is it says real estate taxes cannot go up more than 2% per year, which is great. And as you know, real estate in California has at a much higher rate. So what happens is the longer you've owned the property, the lower your property taxes are vis-a-vis the fair market value of the asset. When you transfer, sell, give away those assets, there might be a reassessment, and that could be a big number. So in California, we have to look closely at this. In other states, it's really not as much of an issue, but in California, it's a big issue. So these are some of the tax trade-offs. So I don't want you, that's why we need the whole A team involved in this planning. It's super important. Okay, let's dive into our first strategy. Now, the first strategy is not a tax avoidance strategy necessarily. This is just low-hanging fruit. If you're able to get, or you already have life insurance, then the first strategy, and this is kind of the easy strategy, right? So if you are able, because you're young enough and your health is good enough, that's the caveat. This couldn't be for everyone. If you were able to get a life insurance policy, you can put that policy into an ILIT. So what's an ILIT? It's an irrevocable life insurance trust. And these have been around for a really long time. This is a well-settled strategy. It's an easy one. And what it does is it allows you, or allows your loved ones, if there is going to be an estate tax, they can pay that tax for pennies on the dollar. So what that means is you get a life insurance policy, and then the ILIT, or the irrevocable life insurance trust, is the owner of the policy and the beneficiary. So if the ILIT is the owner and the beneficiary, and you as the grantor, the creator, you have no incidence of ownership in that trust, then when you die and the death benefit on the policy pays out, it's going to be outside of your taxable estate. So the ILIT can protect the proceeds, and then the death benefit that pays out will protect the proceeds for your beneficiaries from creditors, lawsuits, divorce. It can also have generation skipping transfer tax exemption, so it can pass generationally. So we'll talk about some of those things as we talk about the various strategies. A lot of the themes that I'm going to talk about, they'll overlap in different strategies. So this one doesn't avoid the tax, it just gives you liquidity. So real estate doesn't have to be sold, assets don't have to be sold. It might not be an advantageous time. The federal government wants their tax within 9 months of death. The federal estate tax return is due within 9 months of death. So let's just look at an example. So an example is, say you're single, you can currently gift tax-free every year. It's called the annual exclusion, $18,000. So let's say you gifted tax-free $18,000 to an islet for the benefit of your children. And then the trustee gives notice to the beneficiaries and says, hey, your mom or your dad's made a gift in the trust for $18,000. You have 30 days to withdraw this gift. They say no. Then the trustee will then pay the premium with that gift on the life insurance policy. Say you did that for 10 years. So you paid $118,000 to this trust, and then you died, and there was $1 million death benefit. This is what I'm talking about with the pennies on the dollar. So now the kids or the kid or whomever has $1 million tax-free to pay for any taxes or expenses. And it only cost you $118,000. So obviously, this is an example. Your numbers would be different, but this is a way, this is kind of the low-hanging fruit, like I like to call it. This is the first strategy that everyone should at least consider having as part of their plan. All right, so let's just talk about some high-level concepts. So when we're talking about how to prepare for the sunset and potentially eliminate tax, right? Because if we're preparing for it, we're preparing for that exemption to be cut in half. And we don't want to give, I mean, if you're on this webinar and if you're, I mean, most of us, I personally would prefer to disinherit the IRS and give more money to charities or my children or to other people. I would like intended beneficiaries, not the unintended beneficiary of the tax. So some high-level concepts. You can loan money. You can loan money. You have to charge a minimum federal interest rate, take a note back, but you could get assets out of your taxable estate by loaning your children money. And then there's strategies that we could discuss where you can use your annual exclusion to pay back the note. So you could actually be gifting money to pay back the note. There's a lot of different things you can do, or you could do a self-canceling installment note where you say, okay, you have this loan, they make interest payments, but then when you die, the note cancels, and then all of a sudden all that money is outside of your taxable estate. So loans are an easy way to move money out of your estate. You can gift, you can use your lifetime exemption. You can use that 13.61 or however much you have left. You can leverage that and use that while you're alive, now before the sunset. You can sell assets to others and take a note back. So this strategy is in one of the strategies that I'm going to talk about. There's a sale of assets and then you take a note back. So at a high level, we're talking about loans, gifts, and sales. That's what we're talking about with these various strategies. So let's talk about the first strategy. I would say of all the strategies, this is the one I think everyone's probably heard of. Everyone is talking about, and it's one of those things that I feel like this is a good part. If you're married, this should be and you have a taxable estate, like this strategy should definitely be considered. I call it the soup du jour. It's the soup of the day. It's the number one thing that people do. So it's a spousal lifetime access trust. And the reason this trust is so popular is because you're really not giving up that much as long as you don't get divorced, right? Or your spouse could die. But if those are kind of the two things that make your personal access to the trust go away. I did an entire 20 or 30-minute webinar on the spousal lifetime access trust, so feel free to watch that. It's on our YouTube channel. Subscribe to the channel. It's there. You can watch that, and I go through all the pros and cons, but I'm going to go over an example and just at a high level tell you what the strategy does. So let's say you're married. And if you're not married, then skip this strategy, right? The next strategy is for you if you're not married, so stay tuned. So with this strategy, you're married. And so if you live in California or another community property state, there's 9 community property states, and you have most of your assets are community property, then if you have separate property, then it's not an issue. You don't need to do this. But if most of your assets you've built together as a married couple and your wealth is community property, the first thing you have to do is you have to divide the marital estate. You have to, it's called a transmutation agreement. You have to transmute the community property. That means it's changing form you're transmuting it from community property to separate property. So you should have another attorney involved because of conflicts and all of that good stuff. But you're going to divide, basically, at a high level, you're going to divide the marital estate into a his and a her column. And that's going to be, her separate property and his separate property. Then the spouse is going to give, let's just say one spouse goes first. Maybe it's the husband, could be the wife, doesn't really matter. One, and they're going to gift over $7 million to the other spouse in a slat. Why do I say over 7 million? Because remember back to the slide about the unified credit, if you gift less than that, you're really not taking advantage of the doubled exemption that we've had from 2018 to 2025. So you have this 7-year window where you've got this extra exemption, and you want to use some of that, as much of it as you feel comfortable or your state will allow, because otherwise, in my example, if you only gifted 3, you really haven't helped yourself that much. So they give $7 million to a spousal trust for the benefit of the other spouse. So your spouse is the benefit of the assets. So as long as you guys are married, you're still benefiting from these assets. That's why this strategy is so popular, because you're really not giving up much if you run your household as a community anyway. And then it locks in your estate tax exemption now before it cuts in half. And if structured properly, the assets will stay out of your spouse's taxable estate. So you're using your exemption. When your spouse dies, the slat is not part of their taxable estate. That's why most likely you want a third-party trustee. The spouse could be the investment trustee managing the assets, but to stay out of the taxable estate, and then it can go generation skipping tax-free to your kids and then your grandkids and keep going as long as the money lasts. So this is a great strategy. So let's go through an example. This is why this is probably one of the most popular strategies. So let's do an example, a case study. So husband and wife have a $20 million estate. They're in their late 60s and they have 3 children. So they decide to transmute $16 million of their community estate. 8 million goes to husband's sole and separate property, and 8 million to wife sole and separate property. They leave $4 million in the community property estate, their primary residence, cash, investments. So they're leaving a portion in the community estate, which would probably be part of their revocable living trust. So then H gives $8 million in a slat for the benefit of his spouse and then the kids. And then let's say the next year, now you have to avoid the reciprocal trust doctrine. This is some of the things I talk in the other webinar. You can't do it at the same time. The trusts have to be very different. So they have to be, that's why I'm saying for people who want to do this strategy, you have to do one slat this year. I have clients that did the first slat 2 years ago. The more time in between, the better. And then, so wife could then turn around, the other spouse could then turn around and do a trust for the benefit of the husband and kids, but we're going to have different beneficiaries, maybe a different jurisdiction, different trustee, different powers. We want to make the trust as different as possible so we don't avoid the reciprocal, so we don't violate, rather, the reciprocal trust doctrine. You're going to file return, lock in that lifetime gift exemption, and then California, I'm sure you're not surprised to hear this, you probably already know this, California is not the best state to have a trust. So for these irrevocable gifting trusts, we want to use Nevada, Wyoming, Delaware, South Dakota, Arkansas, etc. We always go with Nevada first, and then we'll use some of the Nevada trust companies as our trustee, and this is a great strategy. So now you've effectively moved $16 million. You've leveraged your exemptions. Now these numbers could be higher. They could have gifted 10, they could have used the full 10, they could have done the full 10, but they've effectively, in this example, have eliminated their estate tax. So, all right. Now, let's say you're not married, or let's say you're married, but you have a lot of separate property, and you want to leverage your 13.61 million before the exemption expires on the sunset. So the third strategy is the legacy trust, and this can be a dynasty trust. So with this one, this is also very popular. With this one, you're gifting assets to a trust for the benefit of your children or other beneficiaries. So let's say that we have a client, and she has $35 million estate, and she wants to start, and a lot of it's real estate, and she wants to start getting the assets using up her lifetime gift exemption. Now, this is one of the things that applies to all the strategies that we're talking about, and that's a valuation discount. So this is where we're going to have to hire a third-party valuation expert. But when you give a partial interest in a business or a partial interest in real estate, so an LLC, maybe the LLC holds real estate, maybe the business is an actual business, an ongoing business. But when you give a partial interest in an asset, and then the person that you're giving it to or selling it to has a lack of control and they have lack of marketability, it's really hard to sell 10% of a property or 30% of a property or 49% of a property. That you have lack of marketability. And then you also have lack of control because the person who owns 51% most likely is going to maintain control of their asset. So you have lack of control and lack of marketability. And so you get a discount. You can discount what you're gifting or selling to the trust by up to 35%. And that's where the valuation expert will come in. They're going to analyze everything and they're going to tell us what the percentage is going to be. So this can apply to the spousal trust we were talking about also. So in this example, let's say there's a $15 million piece of real estate. We apply a 35% discount. So then you've got a valuation discount, of $5.25 million. So then the $15 million real estate is going to be gifted to a legacy trust, and you're only using 9.75 million of your exemption. So then there would be room to gift another asset to get up to the 13.61. Hopefully that makes sense. So the bottom line is, if you're giving a partial interest, we can also leverage the gift. This is how we can eliminate taxes, because with these valuation discounts, you can take a $40 million estate down to zero. So it locks in the estate exemption now. The legacy provisions, you'll have generation skipping provisions so that it can pass tax-free generationally. Another reason why California is not a favored jurisdiction is in California, our rule against perpetuities is 90 years. So what that means is a trust can only last 90 years in California. If you really want to be generationally minded and set up multi-generational wealth, then Nevada is a better jurisdiction. Trust can continue for 365 years in Nevada. There's a state that has 1,000-year rule against perpetuities. So, in our culture, we don't tend to think that long term, but I would encourage all of you to begin thinking a little longer term. Think in terms of your legacy multi-generationally. One thing is to save taxes. The other piece of the puzzle, and honestly, what I've seen over the years, and also just from the research on this topic, saving taxes is somewhat easy. Preserving the wealth in the family is hard. It's hard. It's hard. Statistically, by the third generation, 90% of the wealth is lost. The statistics are very sobering. And there's lots of reasons for that. If people are entitled, they don't work, they don't have incentive. If they're just given money and they're trust fund kids, that really disincentivizes people. Everybody needs a purpose. Everybody needs a reason for getting up in the morning. Everybody needs to work. Not everybody, but most people need to work. There's obviously people who are disabled or other situations, so it doesn't apply to everyone. But generally, our children need to be productive and have a vision and a mission and a purpose in life. And if they're just given money and they don't have the opportunity to develop those things, that's where the squandering of the wealth comes in. So we can lose a big portion of our wealth to taxes, and we can fix that problem, and that's what we're talking about today. But the other issue is a bigger issue. So that's why I encourage my clients to put discretionary distribution guidelines in there and not just give the money to the kids. A lot of clients are also doing a family bank concept. And with this concept, this is really interesting. With this concept, and there's different ways to do it. People use that term to describe different types of planning. But how I'm talking about it is the children or the other beneficiaries can get loans, but they're not necessarily getting outright distributions. I have one legacy family, they're third generation, their grandparents started planning then the parents plan, then now their generation third starting to plan for their children. And they're setting up trusts much in the same way that their grandparents did, where there's access to income and limited access to principal so that that golden goose can perpetuate generationally. And then life insurance can also be used to perpetuate the wealth generationally. All right, so the legacy trust. Now, the dynasty aspect of it, let me describe what that is. So the typical legacy trust, and I would say most of my clients, typically this is how they set it up for the kids. They'll have a lifetime trust, and say in this example, there were 3 kids, there would be a box for Sally, Susie, and Joey, right? So there's a box for the 3 kids and they're separate. So it divides, the trust is going to divide into thirds. With the dynasty trust, there's no division. The dynasty trust concept is there's a common trust for all of them, and then maybe there's a trust distribution committee, and then they can take, they can apply to the committee like, oh, I want to start a business. Well, let's see your business plan. I want to get seed money from the trust to start the business, or, oh, I want a loan to buy a house, and so then you can set up, that obviously takes much more effort and structure and effect, but this is a way to have a dynasty trust that's going to continue, where the golden goose is never going to run out. And if you're in Nevada, you could go for 365 years. So this is a way you can gift money to a trust now, file a gift tax return, use your lifetime exemption before it goes down, and then you can leverage the gift if you have assets, businesses, or real trust, and with the dynasty trust provisions. Okay, this one is complicated, so I'm just going to say that I try to make the complex simple, but this one's a little challenging. So I'm giving you one specific example. There's millions of ways that this strategy can be structured. So I'm just going to give you one example. And this is the IDGIT, right? This is the grantor trust with a gift, sale, or both. And the IDGIT, you'll notice that a lot of these trusts have acronyms. It's like alphabet soup, right? Intentionally defective grantor trust. So people get hung up on the defective part. They're like, why would I want a defective trust? Like, that makes absolutely no sense. Who wants a I don't want a defective anything. But in this case, you might. So the reason it's defective is because you're the grantor, you create the trust, right? So you create the trust, but you're still the owner of you're not the owner for estate tax purposes. So if you sell or gift an asset to this trust when you die, whatever you moved over to that trust is outside your taxable estate. However, because it's a grantor trust and it has certain grantor trust powers, from an income tax perspective, you're still the owner. So you're still the owner for income tax purposes. So what that means is you're going to be paying the income tax. Now, one of our estate planning CPAs, Robert Keebler, who's sort of nationally renowned in this field, he calls this the tax burn, right? So a lot of parents are like, I had one client, we were looking at the strategy, he's like, I don't want to pay the tax. I really don't want to give my kids that much money right now. So he decided not to do this strategy. But here's the thing, you're paying the income tax. If you have a large estate, you're further reducing your taxable estate by paying the income tax. So that's the tax burn. Not only have you moved this asset out of your estate, you're still paying the income on the income, you're paying the income tax on the income generated in that trust. So not only did you get the asset out, but now you're still paying the income. So that's going to further reduce your estate. You could always flip the power in the trust if you don't want it to be that way. You could flip it later. With all these irrevocable trusts, I really endeavor to build in as much flexibility as possible. All right, so what do you do in this situation? So with this one, so hopefully you understand that it's not necessarily a defective trust. It just means you're taxed on the income. That's why, and it's intentional. That's why it's called an intentionally defective grantor trust. But the asset is outside the taxable estate. So it's not part of that when you die, what gets taxed. All right, and then the other thing is, let's say you're going to sell. I'm going to give you an example in the next slide. Let's say you're going to sell an asset to the trust and you take a note back. You have to take the, actually those rates I put on there are not the AFR, that's the 75/20 rate, but you have to pay the minimum federal interest rate, and then that would be, the trust has to pay interest on the loan. So let's just go to the example. And there's no capital gain on the sale because it's a grantor trust. Let's just go to the example because I think this will make a lot more sense when I look at an actual example. All right, so here's the example. So let's say you have a building, and after your valuation discount, I'm just using easy numbers. After your valuation discount, you sell, right? So we're not gifting in this strategy. This one's a sale. You're going to sell 49% of your LLC that owns a building to this grantor trust. And then you're going to have your kids or other, whoever you want as your significant other, I mean, I don't know, whoever you want as the beneficiaries. And then you're going to pay the income tax on whatever that 49% of the income that building is generated. If it's a apartment complex or a commercial building or whatever it is, that income, you're going to keep paying the tax. Now you have to do a seed money gift of 10%. So you do have to gift some cash or assets to the trust because the IRS wants to make sure that the trust can pay the note. So you have to do at least 10% seed gift. You can do more, but you have to do seed money to the trust to make sure that it can pay the note. Now, in this case, you'd have to do well, it depends on the income from the building, if you needed to do a bigger note or not. And then you're going to take a note back. And the minimum federal interest rate for July of 2024 on a long-term note. So this particular note is going to exceed 9 years. There's a short-term, mid-term, and long-term minimum federal interest rate. So the long-term rate for July of 2024 is 4.61. So then I ran this through the calculator, and the grantor is going to receive payments of $469,000. So you're going to get payments on the note every year of $469,000, but you're paying the income tax on. So, money is moving from the left hand to the right hand, back to the left hand. And people are like, is this too good to be true? No, this has been around for a long time. As long as you follow the various regulations, it's a bona fide purchase, fair market value, arm's length. Ideally, you'd have another attorney, another representative of the trust, just so that this is arm's length. This isn't like an interfamily transaction that the IRS is going to collapse. So you do have to observe certain formalities. But if you follow the certain formalities, then you've moved 49% of your building out of your taxable estate, and without using any of your lifetime exemption. And then you're further reducing your estate by paying the income tax on this trust. So this is a very strategy. I gave you one example, but obviously, every situation is different and needs to be analyzed individually. Okay. Whew, we're doing good. Strategy 4. All right. This is the Qualified Personal Residence Trust, aka CUPERT. The CUPERT kind of went out of style for a while. It was really popular in 2010-ish timeframe when the exemption was set. I don't know if those of you remember, it was going to go back down to $1 million in 2011. It didn't happen, but this was a very popular strategy back then. And so what is the CUPERT? So this is a house in La Jolla that was for sale a few years ago. So this picture was in the public domain. But a CUPERT is an irrevocable trust. I have to say that as a lawyer, right? It's an irrevocable trust created by the grantor, and the asset is either your primary residence or a second home. So I think it's better with a second home, but not everybody has a second home that would qualify for this, that wants to do this strategy. But basically what you're doing is you're transferring either your primary residence or a second home into a qualified personal residence trust, so an irrevocable trust, and then you retain an interest. So you're going to retain an interest for a period of years. So it could be 5 years, could be 10 years, could be 15 years, could be 20 years, could be. Now, here's the thing. If you do it for too long, so you have to look at your health and your life expectancy. Because let's say you did a 20-year term and you died in year 10, then it's going to come back into your taxable estate. So you didn't get the house out of your taxable estate. So at the end of the term, the asset passes to the beneficiaries. And then if you're still living in the house, you have to start paying rent. So this is another opportunity for the tax burn, right? Because if you're paying rent, now some people, when this actually happens and they have to start paying rent, it's like, oh, I got to pay my kids rent to live in my house? Yeah, you do. And it has to be fair market value. So if you continue to live in the property, you have to pay rent. But then, like I said, you're further reducing your taxable estate. After the term, the property is outside your taxable estate, passes tax-free to the kids. Now, what's the downside? The downside is there's a carryover cost basis. So if this is not a legacy property that the kids want to keep in the family for a long time, I mean, if it were this house in La Jolla, like that's pretty spectacular. Like you might want to keep that in the family forever. Then this would be a great property to keep in the family if it's a special unique property, because you're going to lose the step up in cost basis. So I've had clients come to me when the exemptions were so high and they no longer had a taxable estate, and they were like, can we unwind? I did a Cupert in 2010. Can we unwind it? With some caveats, you can. There's some caveats though. So anyway, let's talk about an example, right? So what's an example of this strategy? So let's say, obviously this is not a $2 million interest, but again, if husband and wife own the home, this is a potential where you could split the asset and do valuation discounts. We could potentially have some valuation discounts here as well. So in this example, the grantor is gifting $2 million to a Cupert. So $2 million worth of property to the Cupert. The longer the term, the lower the taxable gift. You see that? So if it was a 5-year Cupert, meaning you live there for 5 years, and at the end of 5 years, the remainder goes to the trust beneficiaries, your kids or whomever it is, then your taxable gift is going to be a little bit larger. If it's 10 years, it goes down, 15 years, 20 years. So 20 years, I would only do if you were young, like really young and in good health. But then your taxable gift is a lot lower. So the tax-free transfer to children at the end of the trust term, assuming, as I said, the grantor survives the Cupert term, and then for the taxable gift portion, you can use some of your lifetime gift exemption. And again, if you do a partial interest, we can use valuation discounts here as well. So, and then if you see if the house appreciated 4% and you did a 10-year term, the kids are getting $2.9 million tax-free. So that's the Cupert. It's not for everybody, but that's another strategy. All right, last strategy. Let's see how we're doing. We're doing good on time. The last strategy is charitable strategies. Now, there's multiple charitable strategies, charitable foundations, there's charitable lead annuity trust. You can do donor advised funds. I'm going to do an entire webinar on charitable strategies, so I'm not going to go into great detail, but I'm just briefly going to talk about the charitable remainder unit trust, aka the CRET. We couldn't get away without having an acronym for the last strategy. So this strategy is good if you have a highly appreciated asset and you want to move that asset out of your taxable estate and sell it without paying the capital gain. So it's an asset that you want to sell while you're alive. Could be highly appreciated stock. I've had clients do them for stock. Most people do them for business interests. Most people will do them for real estate, like a rental property. So what you do is you're saving taxes, you're saving capital gains tax, you're creating a charitable legacy, and then the asset is protected while it's in the charitable trust. So how it works is you transfer a highly appreciated asset to a charitable trust. The trustee can then sell the asset and not pay any capital gain, and then you retain an income stream for life or a term of years, up to 20 years. And then the IRS says that the payments that you receive have to be between 5 and 50%. Now, depends on your age and your actuarial life expectancy. If you do it for life for 20 years, then the unit trust payment is not going to be 50%. That's for like a 1-year or 2-year CRET. The unit trust payment is going to be based on a actuarial calculation such that at the time of the transfer of the property to the trust, the remainder value to charity is at least 10%. So you can take 5%, 6%, 7%. Let's say you transferred $1 million to a trust and you took a payment back, and it's fixed of 6.5%, you're going to get $65,000 per year from that trust for the rest of your life. It could be for your life, your spouse's life, could be for your life, and then the kids for a term of years. They're going to get 6.5% for whatever the value of the trust is. The trust will be revalued every year. You're going to get an income tax deduction for the charitable remainder. So you're going to get an offset against your income tax, which you can carry forward for 5 years. And then when you die and when all the recipients are gone, the remainder goes to charity. So and then the asset's completely out of your taxable estate. So the only interest you have during your life is the income interest, and you do pay income tax on your 6.5%, your $65,000. So you will pay income tax on that. You can also use this for retirement accounts. After the 2020 Secure Act, the kids and other beneficiaries no longer can stretch your IRAs over their life expectancy. So the charitable remainder trust would allow them to get a 5% payout for life, and then the remainder goes to charity. So that's another way that this trust can be used to really leverage the lifetime payout. So I have clients with really large IRAs who have leveraged this strategy to really just give their kids 5% from the IRAs for life instead of 10 years and they have to take it all out and pay the tax. So you can stretch it with the charitable trust. And then they're still creating a charitable legacy to charities of your choice. And you can change the charities. It can be more than one charity. You could set up a family foundation. So there's a lot of creative ways that strategy 6 could be used. All right, we got through all 6 strategies. So let's review. What are some of the things that you can consider? The ILIT, the life insurance trust. Hopefully you took some notes. This is recorded and the recording will be available, so feel free to go back and watch it. The SLAT, the spousal lifetime access trust, the legacy gifting trust, the intentionally defective grantor trust with a sale, the QPERT, qualified personal residence trust, the charitable planning, charitable remainder trust. So those are some strategies available to you. This is a picture of a beautiful sunset over a winery. So the sunset is coming. We have about a year and a half. I hope that this has been educational and informative. Remember, you need to do this planning in connection with your wealth advisor, your CPA, and your estate planning attorney. This has been San Diego and Salt Lake City estate planning attorney Kristina Hess.